Welcome back. Let us continue now with the first part of our main lesson. We will look into the forms of investment. We'll be analyzing the impact of the forms of investment. Now let's start. The first form of investment is your RSA retail savings bond. Now, what do we mean by that? This is an investment which is done to encourage savings, and it is done by the South African government, which offers the South African citizens an opportunity to invest in savings bond. The advantage is you get your interest, and the interest is earned twice a year. That becomes an advantage now for investing in RSA retail savings bond. What are the positives now or advantages? The positives are there's guaranteed returns as interest rate is fixed for the whole investment period. So the guaranteed return becomes now the advantage because the interest will be fixed for the whole investment period. Another advantage is that there's no charges, costs, or commissions payable on this type of investment. And then when we look into negatives now, is that a minimum of 1,000 must be invested, which may be difficult for some small investors to accumulate or to have. And then another disadvantage becomes the idea that retail bonds are not freely transferable amongst investors, meaning you cannot sell it to another investor. It will remain your investment until the maturity date or until the time you decide to withdraw. Then another form of investment we have is unit trust. Now, the investments of a number of investors are pooled together into a unit trust fund, and they are managed by an expert. So this is to say money from different investors is pooled together to ensure now that they have what we call a unit trust fund. So maybe 100,000 from this investor, another 100,000 from this investor, and another 100,000 from this investor. Normally it can be 500, it can be even be way lesser, maybe 200, it depends. So they are pooled together to be in a unit trust fund, and they are managed by an expert. Now let us look into the positives here. What are the positives? They are managed, or a unit trust would be managed by a fund manager who buys shares on stock exchange or the Johannesburg Securities Exchange. That becomes an advantage. This fund manager is an expert who knows better about investments, and a small amount can be invested per month. Hence I said it can be 300 per month, it can be 200. It depends with the financial institution. And then the negatives are share prices may fluctuate, meaning sometimes the share prices can make more money, sometimes it can make less, depending on the economic conditions. So it's not good for people who want to invest for a short period, because you will not get returns immediately. You'll have to be patient. So those become the negatives. Then we have shares. Shares now are what the company would be selling for one to become an owner. So companies sell or issue portion of its ownership to shareholders in a form of shares on the open market in order to obtain capital, which is what they'll use to start operating their business. So for them to operate their business, they need capital, and they get that capital by selling shares, which makes an individual a shareholder who would be having a certificate that says, I am a shareholder, basically I am an owner of a company. So the impact of shares now, what are the positives? They can be freely transferable or traded on JSE, meaning someone can sell to another individual if they no longer want to be the owner of that particular company. Shareholders have the voting rights at an annual general meeting, meaning they can vote during an annual general meeting, which is a meeting that is held once a year. What are the negatives now? Shareholders may receive less dividends or no dividends when company profits are low. So basically we're talking about the impact of ordinary shares. We're going to talk about them as our lesson continues. And then another negative is that companies have no legal obligation to pay dividends to shareholders. Dividends are basically returns. These are returns for investing. In shares. So when you invest in shares, you don't get return, but you get dividends. So a company has no legal obligation, meaning they are not forced to give you your returns. It depends on the company performance. Now we look into fixed deposit. The impact with fixed deposit, we're talking about investment that would be done with the bank, and then it offers you interest which is fixed. So the interest is aimed at the fixed rate regardless of the changes in the economic condition or climate. So this is to say, should it happen that interest goes down as per the repo rate, then you will not be affected because your interest will be fixed. And then another advantage is that investors can choose the investment period that suits them, that allows now for them to choose the period to say how long will they want to invest. The negatives now becomes the idea that the investor cannot withdraw their funds before the maturity date of the investment. Hence, we call it fixed. So it cannot allow the investor to withdraw. And then low returns as compared to other investments. So that is the impact of your fixed deposit. Then, fixed deposit, again, to explain the meaning, refers to money that cannot be withdrawn or added during the investment period. And then the investor has to have certain, or they need to be certain that they will not need money for the period of investment. Now, we move into another aspect, which is your types of shares. Now, with your types of shares, we will also be looking into the rights of ordinary and preference shareholders. Now, we have the first type of rights. Here we're talking about founders' shares. These are shares that are issued to the founders or incorporators or promoters of a company. These are people who have started the company. They are called founders, and they will receive founders' shares. They receive dividends after all other shareholders are paid. Remember, these are returns. So meaning they get returns after all other shareholders have been paid. Then we have bonus shares. With bonus shares, these are issued as compensation for unpaid dividends. If it happens that 2 years passes without receiving your returns, you will be paid bonus shares. And then shareholders will own more shares and collect more dividends in future. If you had 70 shares, you will be maybe given 20 more as bonus shares, meaning in future you have to receive 90 shares based on what? The increase which was compensated for via bonus shares. Then, we also have ordinary shares. Ordinary shares only receive dividends when profit is made, meaning they only receive returns when the profit is made. And then shareholders are the last to be paid if the company is declared bankrupt or liquidated. Then we also have the rights of ordinary shares. What are their rights? They have the right to vote at an annual general meeting. Number 2, they have a right to receive interim and annual reports. Then they also have a right to claim on company assets in an event of bankruptcy after all other creditors and preferential shareholders have been paid. Then we look into preference shares. Now, shareholders receive a fixed rate of return, meaning their dividends becomes fixed. If the agreement is to pay them 20,000, they'll receive 20,000, whether the company has made more money or not. And then shareholders have a preferred claim on company's assets in an event of bankruptcy. So should liquidation happen, this is to say now when the company is selling all their assets, they are the first to claim company assets. They are the first to claim company assets because they've been receiving fixed rate of dividends. Even if a company makes $1 billion, they will still receive now 20,000 of their fixed dividends. What are their rights? Rights of preference shareholders. They receive dividends regardless of how much profit has been made because now their dividends are fixed. Another aspect is that they enjoy being paid first or enjoy preferential rights of dividends because their dividends are fixed, and they only have voting rights at an annual general meeting under particular circumstances. So those are the preference shares and their rights. So with that being said, let us take a short break and we'll continue to look into other aspects of the lesson. Thank you.